The year is 1929, October 24th, a Thursday morning that would later be called Black Thursday. But this story doesn't start there. It starts 3 months earlier, in July, when something invisible began to shift. Most people missed it. The wealthy who survived didn't. Picture this: you're standing in the New York Stock Exchange. It's July 1929. The market has been climbing for 9 years straight. 9 years of uninterrupted gains. Everyone's getting rich. Your neighbor bought stocks on margin and doubled his money in 6 months. Your brother-in-law quit his job to trade full-time. The newspapers are calling it the new era. Permanent prosperity, they say. The old rules don't apply anymore. But if you knew what to look for, you would have seen the cracks. Not in the market, in the behavior. The wealthy families, the ones with money stretching back generations, they started doing something strange in July. They began liquidating positions, quietly. Not all at once, just trimming, reducing exposure, taking profits, while everyone else was buying. They were selling. Why? Because they recognized a pattern as old as money itself, a pattern that destroyed the Roman Empire, toppled the Spanish monarchy, and has repeated itself in every major financial collapse throughout history. It's not about charts or economic indicators. It's about human nature, about what happens when confidence becomes delusion. Here's what they saw. In July 1929, stock tips were being shared by shoeshine boys. Housewives were pooling money to buy stocks. Taxi drivers were leveraging their life savings on margin. This wasn't analysis. This was mania. And mania always ends the same way. Always. The pattern has 3 phases. First, the smart money gets in early when assets are cheap and everyone's scared. Second, the masses catch on. Prices soar, and the smart money starts quietly exiting. Third, euphoria hits. Everyone believes it'll last forever. That's when the smart money is completely out, watching from the sidelines. That's when the trap is set. By September 1929, the signs were everywhere. Trading volumes hit record highs, not because of genuine investment, but because of speculation. People weren't buying businesses, they were buying lottery tickets. The price-to-earnings ratios had climbed to levels never seen before. Stocks were trading at 30, 40, 50 times their actual earnings. It made no mathematical sense. But when everyone's making money, math feels irrelevant. The Rockefellers, the Kennedys, the Mellons, these families had seen it before. Their wealth came from understanding cycles, not betting on trends. They knew that markets don't crash when things are bad. They crash when things seem impossibly good, when every possible buyer has already bought, when there's nobody left to bid prices higher. So, they sold in August, in September, in early October, while the newspapers were printing headlines about the endless boom, while economists were declaring a new paradigm, while your grandfather was probably buying more shares, convinced he'd found the secret to easy wealth. Then came October 24th, that Thursday morning. The selling started at 11:30 a.m. Within hours, 12.9 million shares traded hands, a record that would stand for decades. Fortunes evaporated. Millionaires became bankrupt before sunset. Suicides followed. Families were destroyed. And through it all, a small group of wealthy families sat in their estates, their wealth intact, because they'd recognized the pattern 3 months earlier. Here's what matters. This isn't ancient history. This isn't a cautionary tale from your grandparents' era. This exact pattern is playing out right now, in markets you're watching, in assets you probably own. The warning signs aren't subtle. They're screaming. But just like in 1929, most people are too intoxicated by recent gains to hear them. If you're starting to see what I'm seeing, tap that like button and subscribe to The Hidden Ledger, because what I am about to show you next will change how you look at every investment decision you make. This isn't financial advice. This is pattern recognition, and the pattern is repeating. The question isn't whether another crash is coming. Crashes always come. The question is, will you be the one watching from the sidelines with your wealth intact, or will you be the one asking what happened? Let's talk about what comes before every collapse. The 30-day window. The warning period that the wealthy never ignore. 30 days. That's the average window between when the smart money exits and when the market realizes what is happening. It's not exact. Sometimes it's 3 weeks, sometimes it's 6. But there's always a gap, a period where the wealthy are gone, but the masses haven't figured it out yet. This is the kill zone. Why 30 days? Because wealth doesn't evaporate overnight, it bleeds. The first drops go unnoticed. A stock dips 3%, but recovers by close. A sector shows weakness, but analysts call it a healthy correction. The narrative remains optimistic. CNBC is still bullish. Your financial advisor is still recommending you stay the course. Meanwhile, the foundations are crumbling. Let me show you what this looked like in real scenarios. Amsterdam, 1637. Tulip mania at its peak. A single tulip bulb sold for more than a skilled craftsman earned in 10 years. People mortgaged their homes to buy tulips, not to plant them, to flip them. Everyone knew someone who'd tripled their money in a month. Then, in February, the auctions started coming up empty. No buyers. The wealthy collectors had already exited weeks earlier. Within 30 days, tulip prices crashed 99%. Fortunes disappeared. The smart money. They'd converted their tulips back to gold a month before. London, 1720. The South Sea Bubble. A trading company's stock rose 1,000% in a single year. Isaac Newton himself bought shares. Even geniuses fall for mania. By August, insiders were selling. Quietly, discreetly. The public kept buying. 36 days later, the collapse began. Newton lost the equivalent of $3 million in today's money. He famously said afterward, "I can calculate the motion of heavenly bodies, but not the madness of people." The insiders who sold in August, they became the next generation's wealthy elite. Tokyo, 1989. The Japanese real estate bubble. At its peak, the land beneath the Imperial Palace was worth more than all of California. Banks were giving 100-year mortgages. 3 generations of debt for a single apartment. Absurd, right? Not to people living through it. It felt normal, inevitable. Then in late 1989, the Bank of Japan started tightening. Foreign investors began withdrawing. Nobody panicked, not yet. 31 days later, the Nikkei started a decline that would erase 80% of its value. The crash took years to play out, but the warning was there in that first month. See the pattern? The wealthy don't have crystal balls. They have pattern recognition. They understand that markets are driven by psychology, not fundamentals, and psychology is predictable. Greed always overextends. Fear always overcorrects. The cycle never changes, only the assets do. Here's what happens in that 30-day window. First, volume changes, not price, volume. The wealthy are large players. When they exit, even gradually, it shows up in trading volumes. More shares changing hands, but prices staying flat or rising slightly. That's distribution. The smart money distributing their holdings to the dumb money. Second, quality divergence. The best assets start underperforming. The garbage starts outperforming. Why? Because the sophisticated money owns quality. When they sell, quality dips. The unsophisticated money, the late arrivers, they're chasing the exciting garbage, the penny stocks, the meme plays, the next big thing. This is the final stage of mania, when the worst assets do the best. Third, narrative shift. The stories change. Suddenly, analysts are talking about new metrics, new valuations. This time it's different becomes the refrain. Traditional measures don't apply anymore. We're in a new paradigm. This is the most dangerous phrase in finance. It's never different. The math always catches up. Fourth, insider selling. CEOs, board members, the people who supposedly know their companies best, they start selling their personal shares. Not all of them, just enough. They'll tell you it's for diversification, for tax planning, for a new house. Don't believe it. They're reading the same pattern. So here's the critical question. Are we in that 30-day window right now? Let me show you what's happening in today's markets. What the data is screaming. What most people are deliberately ignoring because the truth is uncomfortable. Let's talk about now. About what's happening in the markets you're watching. About the signals that are flashing red while everyone's celebrating green. Cryptocurrency. At the time of this recording, Bitcoin and various altcoins have experienced massive runs. Life-changing gains for early adopters. Everyone's talking about it. Your uncle who doesn't understand technology is asking about crypto. Celebrity endorsements. Exchanges running Super Bowl ads. Sound familiar? In the last cycle, institutional money got in early. Smart money. They bought when Bitcoin was crashed, when everyone said it was dead. They accumulated through 2018, 2019, 2020. Then 2021 happened. Retail mania. Everyone buying. That's when the smart money started. Distributing. Not all at once, gradually, quarter by quarter. By the time Bitcoin hit its peak in late 2021, institutional holdings were declining. They weren't on CNBC announcing their exits. They were quietly selling to retail buyers. The crash followed. 70% drawdown. Fortunes vaporized. The pattern repeated perfectly. Now watch what's happening. We're back in accumulation phase transitioning to distribution. The same institutions that sold the top are buying again. But here's the key. They're also preparing exit strategies, setting price targets, planning the next distribution. Because they know the cycle. They've studied 1929. They've studied every bubble. They know retail will chase. They know when to let retail hold the bag. Artificial intelligence stocks, the latest new paradigm. Companies adding AI to their name and watching their stock price double. Sound familiar? It should. In 1999, it was .com. Companies added com to their name and their stock soared. Most of those companies no longer exist. The AI revolution is real. The AI stock bubble is also real. These two facts can coexist. Smart money knows this. They're invested in actual AI leaders, but they're watching the mania spread to companies with no real AI business. That's the signal. When garbage starts flying, the top is near. Real estate in certain markets. We've seen this movie before, 2008. But people have short memories. In multiple cities right now, we're seeing bidding wars, waived inspections, all cash offers above asking price. Investment firms buying entire neighborhoods. Everyone convinced prices only go up. Meanwhile, interest rates have shifted. Affordability is at historic lows. First-time buyers are being priced out. Who's buying? Investors, speculators, people who already own multiple properties. This is distribution. Wealthy sellers transferring properties to over-leveraged buyers at peak prices. Look at the insiders selling data across major indexes. It's not anecdotal, it's measurable. CEOs and executives across major corporations have been selling their personal holdings at rates not seen since 2021. Since the previous peak, they're not panicking. They're methodically exiting, creating diversification narratives. Meanwhile, retail investors are buying index funds, convinced that passive investing always wins long-term. Long-term, sure, but timing matters. Buying at peaks means decades of waiting to break even. Here's what's different this time, and I'm aware of the irony of that phrase, but this matters. The wealth gap. It's wider than it's ever been. The wealthy have more resources to weather crashes. The middle class has less cushion than in any previous generation. When this pattern completes, when the cycle crashes, the recovery will be asymmetric. The wealthy will buy the bottom. Again, the cycle perpetuates. The warning signs are clear. Volume anomalies in major indexes. Quality. Stocks underperforming speculation. Narrative shifts to justify valuations that don't make mathematical sense. Record insider selling. Retail mania in the riskiest assets. And most telling, complacency. Everyone's become comfortable. Crashes happen when nobody expects them. Wrong crashes happen when everyone's become numb to risk. When leverage is normalized. When fear feels like an outdated emotion. We're not in 1929. The mechanics are different. We have circuit breakers. We have central banks with more tools. We have better information flow. But we have the same human psychology. The same greed. The same delusion that this time will be different. And human psychology is what drives markets. Always has. Always will. So where does this leave you? 3 months from now, will you be the person wondering what happened? Or will you be the person who recognized the pattern? The choice isn't about predicting the exact top. It's about risk management. About understanding when the risk-reward ratio has shifted against you. About knowing when confidence has become delusion. Let me show you what happens after the crash. Why understanding the pattern isn't just about preservation. It's about the greatest wealth transfer in history. Here's what nobody tells you about crashes. They're not destructive. They're redistributive. Wealth doesn't disappear. It transfers from those who don't recognize patterns to those who do, from the confident to the prepared, from the masses to the minority. After Black Thursday in 1929, after the dust settled and the suicides stopped making headlines, something remarkable happened. The Rockefellers, who'd sold at the peak, started buying, not immediately. They waited. They let the panic complete. They let prices fall to levels that made mathematical sense again. Then they accumulated. By the mid-1930s, their wealth had doubled, not because they got lucky, because they understood the cycle, the same pattern repeated after every major crash. After the dot-com bubble burst in 2000, Warren Buffett, who'd been criticized for not participating in the tech mania, suddenly had capital to deploy. He bought quality assets at discount prices. His wealth compounded massively over the next decade. After 2008, investors who'd preserved capital bought real estate at 50 cents on the dollar. Those properties are now worth 3, 4, 5 times what they paid. After the 2020 COVID crash, smart money bought the dip while everyone else was paralyzed by fear. This is the part of the cycle that matters most, the transfer phase, the opportunity phase. But you can only participate if you've preserved capital. If you're fully invested at peak prices, you can't buy the bottom. You're stuck hoping for recovery. And recovery takes time, sometimes decades. Let me give you the framework. The wealthy operate on a 4-phase cycle. Phase 1, accumulation. Buy when everyone's scared, when assets are cheap, when the narrative is pessimistic. This requires courage and cash. Phase 2, markup. Hold while prices rise. Let the trend do the work. Don't get fancy. Just hold quality. Phase 3, distribution. Sell when everyone's euphoric, when you feel guilty for not buying more, when your friends think you're crazy for taking profits. This requires discipline. Phase 4, markdown. Wait. Preserve capital. Let the crash happen. Don't try to catch falling knives. Be patient. This requires wisdom. Most people operate opposite to this cycle. They get scared during accumulation. They FOMO during markup. They hold during distribution. They panic sell during markdown. They buy high, sell low. They do exactly what the wealthy need them to do right now. Based on the signals we've discussed, we're somewhere between late distribution and early markdown. The exact timing is unknowable, but the phase is clear. This is when the prepared start moving to safety, not completely, not panicking, but reducing exposure, taking profits, building cash positions, preparing for the next accumulation phase. What does this look like practically? It means questioning your portfolio. Are you 100% invested because you're bullish, or because you're afraid of missing gains? It means taking profits on your winners, not all of them, but enough that you sleep well. It means avoiding leverage. Debt amplifies gains in bull markets and destroys wealth in crashes. It means having cash. Cash feels stupid when markets are rising. Cash is king when markets are crashing. It also means education. Understanding the pattern intellectually is different from executing emotionally. When everyone around you is making money and you're in cash, the psychological pressure is immense. You'll feel stupid. You'll question yourself. This is normal. This is the test. The wealthy pass this test because they've seen the full cycle. They know the euphoria is temporary. They know the transfer is coming. The greatest wealth in history wasn't built by perfectly timing markets. It was built by understanding cycles, by being greedy when others are fearful and fearful when others are greedy. This isn't a cliche. It's an operational framework. It's how generational wealth is created and preserved. So here's your assignment. Watch the signals, volume, quality divergence, narrative shifts, insider selling. Don't trust me. Verify independently. Study past crashes. Read the histories. Understand that the pattern has repeated for centuries and will continue repeating. Human nature doesn't change. And most importantly, ask yourself, when the next crash comes, and it will come, who do you want to be? The person asking what happened, or the person who saw it coming? The pattern is repeating. The 30-day window might already be open. Drop a comment with the word anti-fragile if you're committed to being on the right side of the next transfer. And subscribe to the Hidden Ledger, because understanding these patterns isn't optional anymore. It's survival. The wealthy knew it was coming. Now you know too. What you do with that knowledge determines everything.